When I started my career, the US dollar was 12 rupees.
Oh.
Now it is 86 rupees. You look at 2010 to 20, the Indian equity markets gave zero returns in dollar terms. India is less than 5% of the world market cap. So there is no logic why 100% of your money should be here. One of the reasons why Indians have this home country bias is that
Devina Mehra is the chairperson and managing director of First Global, an Indian PMS and global asset manager. She's also the author of Money, Myths and Mantras, the ultimate investment guide. Today, she joins us to discuss why global diversification is a key to strong investment strategy.
US have been doing extremely well for the last 10, 12 years. More people go abroad to study, they settle abroad. And US, while it is the largest market in the world, the US is not the world.
If someone is looking to invest globally now, what are the steps that they need to take?
One option is that you...
So Devina, a quick rapid fire. Who should not think of global investment?
Everybody should.
What has been your mantra for investing globally over the last 25 years? Devina, so let's get off to the basics. The fact that India is one of the most promising and fastest growing economies. So why then do you see the need to invest overseas and diversify?
So global diversification is a cause for me, and that's with cause, because to just give you one number, when I started my career, the US dollar was 12 rupees.
Oh,
now it is 86 rupees. So it is 85% depreciation in the course of a career. And so whenever you're talking of long-term financial planning, what are your goals 10, 20, 30 years away, there's no way you can ignore this fact. Much more than when I was studying or working, started working, more people go abroad to study, people's kids go abroad, they settle abroad. Many people want to spend part of their retirement overseas, which means that they have hard currency expenses. So as I said, once you're looking at the long term, first of all, this is a fact. The other part is that India is less than 5% of the world market cap. So there is no logic why 100% of your money should be here. And this is something called home country bias, which of course is there everywhere. If you look at Canadian investors, they might have 60% of their money in Canadian equities. Canada is not 60% of the world market cap.
Yeah.
So, I mean, if you tell a UK investor that put 90% of your money in Germany, they will say, why should I do that? But they might be putting 95% in UK.
Yeah.
And the fact is, if you look at it absolutely logically, you should have less in your home country because you're already exposed to your home country in many ways through your career, through your real estate, all of that. Yeah. So there's no reason to have all your investment eggs in that basket. And it came home to me. I mean, that was really the reason why we at First Global went global 25 years ago. And the immediate trigger was the Asian crisis. And you talked of India growing well. In the 90s, the fastest growing economies in the world were the so-called Asian tigers. Yeah. India wanted to be an Asian tiger. And then one fine day, that whole thing collapsed, and all those Asian tigers, between the currency and the markets in dollar terms, all those markets went down between 50 to 90%. So the lowest was Taiwan at 50%, the highest was Indonesia at 90%, and South Korea, Thailand, the Philippines, all were between this 50 and 90. And that was a wake-up call for me that this is the danger of being in a single market, that if I was an Indonesian investor, and I'd briefly, for a few months worked in Indonesia, I said, I would have lost 90% of my money in a year's time. So there is absolutely no reason to put all your eggs in one basket. It's as simple as that. And one of the reasons why Indians have this home country bias to a much higher degree is that earlier there were capital controls and you could not invest overseas. So to that extent, our grandmothers were not wrong to buy gold. Yeah. Because gold was the only currency hedge available.
Yeah, there was no other way.
There was no other way. So, but now that's not the case. Now the liberalized remittance scheme of the RBI is very generous. It is like $250,000 per person per year. So family of 4, you can send out $1 million. That's like 8.5 crore rupees. It's pretty generous. But still, because that old mindset hasn't gone away, When I started working, and for a good bit after that, you could take only $500 out of the country once in 3 years. For your other overseas trips, you could only buy $20.
Yeah.
The credit cards are not. The credit card has this thing saying valid only in India and Nepal. So, so that was a different era. But I think that it affects how you look at things.
Yes. And maybe that's the reason, Devina, with this home country bias, that there are a lot of misconceptions when it comes to diversifying and putting your money outside, especially maybe with the older generation. What are the myths and misconceptions you want to bust?
So, as I said, first of all, people don't look at global diversification in the first place. Over a period of time, if you look at absolutely logically, it should be a lot higher, but have at least 30 to 40% of your money overseas. The other major thing is that people think that I buy a NASDAQ ETF or I buy the 5 tech stocks I know the names of, and that is good enough. Or depending on what is doing well, you have all these launches of Greater China Fund, US Tech Fund. So don't go into very narrow themes or very narrow regions. And US, while it is the largest market in the world, the US is not the world. And people do not realize that this is a true truism in markets, that no theme lasts forever. No geography, no asset class, no sector. No theme lasts forever. So US has in particular, and developed markets in general, have been doing extremely well for the last 10, 12 years. They have really outperformed emerging markets. I'm not saying that's going to change in the next 6 months, but some point it is going to change. Basically, your money outside should be truly global. So there should be tactical reallocation at various points. So if I go back in history, for example, 2003 to 7, that was a period when US market was already down after the tech crash of the early 2000s. Even so, in that period, the US did terribly. US in that 5-year or 4.5-year went up only 66%. The emerging market index went up 3.5, 4 times. India went up 6 times. Brazil went up 10 times. So always remember, the stories or the narratives follow what is happening in the market. So when that was going on, the whole story began that US is over, and now it's the century of India and China. That's when that BRICS was also coined, that now the attention of the world will go to BRICS. Now 10 years, the US does well, everyone forgets it. Even in 2021, when NASDAQ was doing so well, there were a spate of these NASDAQ ETFs and funds even in the Indian market. And at the time, not in hindsight, at the time I had said that NASDAQ has done fantastically well for 3 years. You think it will last forever? That's not going to happen. And 2022, NASDAQ was about the worst performing index in the world. People have forgotten that. NASDAQ from the top went down 40%. Many of the major stocks went down 50, 70, even 90%. And many of those people who had bought those ETFs then said that, should I now sell it? I said, now you will compound a bad buy with a bad sell, because a stock down 40% can still be a sell. A major index, once it's down 40%, it is unlikely that it will not bounce back. So from being the bottom in 2022, 2023, again, NASDAQ went to the top of the pop. So that thing keeps happening.
Yeah.
You cannot get locked into a single theme, that I will only buy the Magnificent 7 US tech stocks, and that is good enough for global diversification. So that's the part you should get out of.
Devina, if someone is looking to invest globally now, what are the steps that they need to take, or what are the prerequisites?
See, now the LRS process itself is fairly simple, meaning it doesn't take more than a couple of days to actually transfer money. So you can either, one option is that you can yourself open a global or a US broking account, and that you can transact in securities directly, you can transact in ETFs directly. So for example, then there is no reason to buy an ETF from an Indian fund house. You can just as well buy it directly. There's no need to add a layer of cost. Or like in fund of funds also, there's really a layer of cost that is getting added with no accountability because the fund is getting managed elsewhere. So the Indian fund manager cannot give you why this happened or why that happened. So those are of course options that you can do. As I said, invest directly or through mutual funds. But of course, mutual funds, there is a cap, and I think that cap has been hit. So you can't really invest through mutual funds. A few India mutual funds invest a little bit overseas, so that's there. So as I said, this is a cause for me, and because it's a cause for me, we have a product which is all assets, all geographies, that starts at $10,000. So only about 8.5 lakh rupees. Normally in a international private bank, you will not get access to something like this for less than $1 million. I mean, that's usually it's a private banking product, but as I said, I want Indians to start investing abroad. So that's in a portfolio format, or we have a fund format which starts at $100,000 because that's a regulatory minimum. But you can do all of those things. You can even have a fixed income portfolio, non-equity.
Yeah.
But if you're looking at fixed income, I would say that, of course, we have a managed product, but even if you don't go in for a managed product, at least go in for a pooled fixed income, meaning buy an ETF rather than buy individual bonds.
Okay.
Because individual bonds means that you are taking a risk on one particular entity, which is, and since the minimums for buying a bond are quite high, that means you're taking a large risk on a single company or a single entity. So do not do that. Because fixed income, why do you buy fixed income? To reduce your risk. So the last thing you want is to add risk with credit risk.
What are your views generally on the SEBI limitations when it comes to mutual funds, individuals, etc.? And can you take us through some numbers maybe?
So I don't think they're actually coming from SEBI. They're really RBI regulations because of essentially controlling the amount of capital that flows out of the country. So you have the liberalized remittance scheme of this $250,000, but what you're investing in mutual fund doesn't come under that because that is considered a local rupee investment. So they have put a cap on how much the mutual funds can invest abroad. So that's part of the overall capital control. I think SEBI is only a conduit for doing it, but it's really coming out of the RBI or the government's decision on how much of capital outflow to allow.
And how do you think investors can balance the costs and the benefits of using such schemes like purchasing ETFs or stocks via LRS?
The transaction costs are not very high.
Okay.
Especially for ETFs, they're not very high. That's why I'm saying there's no point adding an Indian layer of cost if that you buy a fund which then buys a ETF, then you may as well buy the ETF.
Are there any risks of investing globally and diversifying and using the LRS scheme?
I mean, if you're investing in equity or any risk asset, you have a risk. So the whole point is that you're diversifying that risk by investing not just in India. I just told you the Nasdaq went down 40% not very long ago. 2022 is, very recent. So those kind of things happen. Yeah.
But that aside, in your latest book, Devina, which is Money, Myths and Mantras, you have a concept called SCARS. Take us through that.
So SCARS stands for single country, single currency, single asset risk.
Okay.
So let us say you're invested only in Indian equities. That means you are only in India, in Indian rupees, in only equities.
Yeah.
So that increases your risk profile. And many times people talk of asset allocation. In fact, we were one of the first people to start talking of asset allocation. And there are these studies which show that 85 to 90% of the returns you make come from asset allocation and not from particular security selection. So we all have these cocktail party stories of this stock we found, but really most of the return comes from asset allocation. But again, I see a lot of people talking of asset allocation and they think asset allocation means that you buy Indian equities, maybe within equities, value versus growth, small cap versus large cap, and you put little bit of tadka of some gold and some Indian fixed income, and that's good enough. But that's not good enough, because when you talk of this 85-90% return from asset allocation, you have to have in your consideration set all geographies, all asset classes. So it has to be, if you just go beyond India to US equities, that's not good enough. So you have to have everything from US equities, other developed markets, emerging markets, and not just equity, also debt, also little bit of commodities. So once you put it all together, that is what the real asset allocation is, and to get you away from scars, because that can scar you.
So real diversification is what you're
Yes.
talking about. But you know, that's so different from the narrative that we are fed every day. You put on the TV to a business news channel, you get social media on, and you're fed one thing: SIP sahi hai. That's the route that you should go for. You guys had the foresight 25 years ago. But even today, that's still the same narrative that we're being fed. What do you want to say to that?
See, first of all, I wouldn't say that it is without basis, that fine, SIP, start SIP, because the sooner you start saving and investing, the better it is for you. So, I mean, even if it is not optimal, at least if you start working at 23 and you start saving, even if it is not 20% of your salary, you start with 5% of your increment, you invest a little more. So that's at least better than not doing anything or putting it all in for fixed deposit. I never say put 100% in equity, whether in India or elsewhere. Even if you're young, even if you're in a good job, never put 100% in equity, because equity is money that you truly should not require for 5 to 10 years at least. So there are always unforeseen financial calls on your money. So it's not that there's anything wrong with doing SIP, but that is not good enough. Yeah. It is better than not doing anything, but that's not optimum either. So it is that is the part that you have to, especially when you are young. As I said, when I started working, the dollar was 12 rupees. So, that if you just bought dollars, if you could have, at that time you could not have that itself.
Ka-ching. You'll be cashing it in,
Yeah, so that is something you have to keep in mind. So, always think through the whole thing, don't just, and you think through doesn't mean that, as I said, you don't have to pick every stock, but at a broad level, you must know where your entire money is and where you want it to be in terms of the allocation across geography and across asset classes.
A lot about investing as well, even when it comes to global diversification, we're talking about myths that need to be busted, but a lot boils down to temperament or behavioral biases. Can you tell us a little bit more about the interlink and how that weaves its way into investing habits?
In fact, a lot of it is there in my book. Because this is one of my favorite topics. I often say that I can teach a business school course on this, because your brain really trips you up. The brain is not optimized to maximize your portfolio value. So because this is out of thousands of years of evolution. So the brain is oriented towards only two things: survival and procreation. So for example, why do we want to do what everyone else is doing? Why is this feeling of FOMO that we want to get onto the bandwagon? Because when we were hunter-gatherers, if you were not part of the tribe, you obviously you would not have been able to procreate. You probably would not have been able to survive either. So we are the progeny of people who chose to stay with the tribe. So it is very hardwired within us. I often say that, why do you buy branded bags? And that goes back to your cave man and cave woman days, because you want to belong to the tribe. So, and it is so hardwired. Like Daniel Kahneman, he died last year at age 90, and he worked in this field for nearly 70 years. He won a Nobel Prize for it. And he said, still, I find that my decision making has barely changed, because just intellectually understanding the biases does not remove them from your decision making. It is that hardwired. So in fact, that is the reason why we use what we call a human plus machine system. Machine meaning artificial intelligence, machine learning, because that's the only way to override biases. One is biases, which are systematic. There's also noise. That in a room, people with equal amount of experience and expertise, if you give the same data for the same company, they will come to different conclusions. You yourself will change your mind depending on whether you had a fight in the traffic today, or you're not studies show that if you want bail from a judge, if you go before lunch, you are much less likely to get it than after lunch. So that is what being human is all about. So that is why we use quantitative systems, because that's the only way to override human biases and human noise.
Yeah, and they're so prevalent and they exist. And you as well, with the use of AI, you guys have been using that very optimally. Tell us a little bit more when it comes to investments, PMS, etc., how AI plays a role.
So that's what I said. We use a human plus machine system. So obvious thing is obviously, and we're not using it because AI is available or it is fashionable. There's been a fundamental change in investing, and people are still doing things the way they were done in the 90s, and I enjoyed the 90s. In the 90s, the edge was an information edge, that you meet a company, you get some information, which was true not just here. I mean, Fidelity could sit in a room with a Procter & Gamble or IBM and get some information. But now across the world, that has been regulated away.
Yeah.
I mean, in the 90s, if I wrote a negative report on a company, and I'm talking large companies, even Tata Steel or something, they wouldn't call you for the next analyst meet. But now by law, all transcripts have to be on the website. So now there's lots of information. Information arbitrage is gone, but there's like, who can analyze this masses of data? And that's where AI comes in. Globally, we look at more than 20,000 securities. It's humanly not possible to look at 20,000 securities, no matter how large a team you have. Because even if I have 1,000 people looking at 20 companies each, they will not look at it the same way. So that's where you really need the expertise, and that's what enables us to go beyond the companies everyone has heard of. Like if we go to China, for us, China is not just Alibaba and Tencent and 2 other companies. We could be buying a shoemaker in China. We could be buying, some company doing something quite different. So that's what also the machine enables you to do.
I think that as well, you talk a little bit more about, the importance of selling, because everyone's telling you when to buy a stock, what's the right price, what's the right time, but selling, there's not much said about that. So what do you want to say about that, or what do you want to share?
Yeah, that's so true. In fact, I often tell people that when fund managers come and tell you their story of how they pick stocks, they will tell you a lot about how they pick stocks. But very few, as I dig deeper into the risk management and when they sell, that's the part which nobody really focuses on. And I repeat this often, like investing is a loser's game. And there's this old article of Charles Ellis, in 1970s article, which is about how everything in the world is either a winner's game or a loser's game, and games change. So investing now is a loser's game. Maybe in our grandparents' time, it was a winner's game when very few people knew about companies. Excel sheets did not exist. Even getting an annual report used to be a task. Now it is a loser's game, which means that, for example, aviation used to be a winner's game, meaning when JRD Tata was flying, it was an adventure sport. Now there's only one way to fly an aircraft. Make no mistakes, go by the checklist. So now investing is a loser's game, meaning first of all, your focus should be not to lose. So you will win if you don't lose, which means you don't take crippling hits on your portfolio. Because one of the very hardwired biases in us is loss aversion bias. And that is one thing which the machine is much better at, because the machine has no emotion about admitting mistakes.
So Devina, before we let you go, a quick rapid fire. So we're going to give sort of precise and concise answers here. One factor, if you had to consider while investing globally or diversifying globally, what would it be?
Tactical reallocation.
Okay. Who should not think of global investments?
I think everybody should.
What is the number one myth that you want to bust about global diversification?
That if India is growing well, you don't need to diversify.
And that was my first question. What has been your mantra for investing globally over the last 25 years?
Learn and then understand and then invest.
Devina, thank you so much. That's really been insightful. So thank you so much for sharing those details. Lots of key takeaways from this episode on the importance of diversifying globally, the fact that India is just less than 5% of the global market cap. So it's important not to put all your eggs in one basket and to diversify globally, not just in equities, debt, commodities, make use of it all. But do remember to follow all of the legal and tax compliances. The US market is not the rest of the globe, so do make sure that you invest across all different markets, and asset allocation is key. But the most important, of course, is to remember to consult a qualified, personal, unbiased financial advisor for all your investment decisions. Would love to know, would you look to diversify globally in the year 2025? Do share your thoughts in the comments section below.